Welcome back, everyone. Today, we are unpacking an absolute economic head-scratcher that is leaving millions of people deeply confused. If you have checked your investment portfolio recently, you probably noticed something amazing. The S&P 500 rallied nearly 10% in the first half of 2026, which is more than double its historical average. But then, you flip over to the evening news and hear a completely terrifying headline. The entire United States economy managed to add a miserable, cratering total of just 57,000 jobs in June. On paper, these two massive numbers feel completely contradictory, like they simply should not coexist in the same reality. How can corporate equity values be aggressively skyrocketing while everyday working people are watching the labor market actively freeze up? Well, this massive gap is not an accident, and today we will break down exactly why it is happening. To understand this strange phenomenon, we must first dismantle a classic myth that trips up almost every single casual investor. The stock market is absolutely not the broader economy. Think of the stock market as a forward-looking scoreboard reflecting the projected future profits of massive, highly sophisticated global corporations. These mega firms can easily grow their bottom-line earnings by deploying advanced automation, aggressively cutting operational costs, or generating substantial revenue from international markets. On the flip side, the actual economy represents the current, localized financial health of real, everyday citizens, heavily driven by wages, local retail spending, and immediate domestic job availability. While a giant tech corporation can thrive by ruthlessly optimizing its workforce, the average worker suffers when those local jobs vanish. This fundamental separation means that corporate equity prices can easily throw a wild celebratory party, even while local main streets are severely struggling to survive. This current divergence is being heavily amplified by a massive structural phenomenon known as concentration risk. To visualize this clearly, imagine the S&P 500 index as a massive, heavy wooden cart being pulled up a steep hill by a large team of 500 distinct workers. Right now, a tiny handful of hyper-muscled, gigantic tech bodybuilders, representing the elite AI-driven mega-cap stocks, are sprinting ahead at full speed. They are single-handedly dragging the entire heavy cart uphill completely by themselves. Meanwhile, if you look closely at the back of the rope, the other 495 regular, average-sized company workers have completely tripped, fainted, or stopped pulling the weight entirely. Because the S&P 500 is fundamentally weighted by market capitalization, the massive size of these few AI giants completely masks the deep exhaustion and structural pain felt by the rest of the market. If this unsettling economic setup feels incredibly familiar, that is because we have collectively seen this exact movie play out before. Historical precedents show us that the last 3 times we witnessed such an aggressive decoupling between equity indices and underlying job data, major economic storms followed. Think back to the infamous dot-com bubble peak in late 1999, where hyper-hyped internet stocks soared sky high, while the broader manufacturing sector was already slipping into a quiet recession. We saw a similar false sense of security emerge in mid-2007, right before the devastating subprime housing crisis brought down global financial markets. When a tiny group of speculative stocks completely detaches from the painful reality of everyday economic fundamentals, history strongly warns us that the broader index is usually skating on incredibly thin ice. The critical lesson here is that narrow, concentrated market rallies are inherently fragile and rarely sustainable long-term. So, how do we actually know when this massive structural music is finally about to stop? Investors must keep a hyper-vigilant eye out for one specific macro signal: a sudden, rapid deceleration in AI infrastructure spending by the mega-cap tech giants. Right now, the entire massive stock market rally relies entirely on the heavy assumption that these tech companies will generate trillions in future artificial intelligence revenue. If major corporations suddenly begin cutting back their massive microchip orders, or if tech earnings reports finally reveal that their massive AI investments are not paying off, the core engine pulling this entire cart will instantly stall. When those few giant bodybuilders suddenly lose their footing, the massive weight of the other 495 stagnant stocks will pull the entire index down fast. Watch the tech capital expenditure data closely. That is where the real truth lies hidden. Experiencing this extreme economic divergence can feel deeply overwhelming, but you do not have to panic. Navigating this chaotic landscape successfully simply requires moving away from reckless speculation and shifting toward a highly disciplined, deeply diversified investing strategy. Avoid the dangerous temptation to blindly chase the hyper-hyped tech stocks at their absolute all-time highs. Instead, focus your energy on identifying fundamentally sound, resilient businesses with strong cash flows that are currently being completely ignored by the frantic, AI-obsessed crowds. Remember, true wealth is built by understanding the real data, staying incredibly patient, and remaining perfectly calm while the broader market rides these wild, unpredictable waves. Keep your head clear, stay focused on the long game, and you will navigate this crazy economic paradox like an absolute pro. If you found this breakdown valuable, make sure to hit that subscribe button for more clear financial insights. As always, appreciate you hanging out today. See you in the next one.